Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be talking about trading covered calls, and specifically, we're going to be talking about three very different reasons why some traders choose to trade covered calls. You might think it's all about income. Well, yeah, it can be about income. Commonly is, but there can be other motivating factors as well. We're going to be talking about that in good detail over the course of our 45 minutes. But before we get to any of that, let me first of all say hello to everybody that's chatting in. Great to see so many good familiar names out there. Hello there, Chuck and Will. I never eat here, Will. Let's see, Thea, Ricebird, John, Eva, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in the live stream here. If you'd like to be here, this is a Monday webcast series, and we kick things off promptly at 2 o'clock Eastern Standard Time. We'd love to have you here in the live stream audience. I also want to let everybody know here in the live stream audience that my very good friend Barb Armstrong is hanging out in the chats with us today. Barb's going to be addressing any questions that I can't get to just during the natural flow of the presentation. Thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to everybody listening. If you have an account with X, give us a follow there. Follow your favorite presenters there. It's the best place to connect with your favorite presenters. In between these live streams, you can find Barb there on that platform at Barb Armstrong CS is her handle. My handle there is at Cameron May CS. But let's get into this discussion of the motivations for trading covered calls. And as we do that, of course, we need to consider the risks associated with trading. Risk is real, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for the day. And the agenda is pretty similar from week to week in this series. The first thing that we do is we take a look at our existing positions. Then we take a peek at the markets to set sort of a foundation for our discussion. And then we talk about the strategy of the day, and today it's going to be about covered calls and the specific motivations that are very different from one trader to the next for why they choose covered calls and how might that influence the covered call that they choose to trade. So let's go. By the way, Momo says, do you have a playlist for covered calls that you can please attach? I do have a playlist, Momo. Let's actually lead off with that. That's great. If you are new to our channel, welcome. Make sure, though, that you have subscribed to the channel. You can pop down below the video stream right now and click on the subscribe button. It literally only takes a second. It doesn't cost anything. But our Trader Talks Schwab Coaching Webcasts YouTube channel is where we house things like playlists that are topic specific. So, for example, if you wanted to find this webcast series, which frequently talks about covered calls, as the name implies, we can go to the playlists here, and then scroll down. It's a little bit down beyond the halfway point. And right now it's going to be featuring Mike Fairborn's face because he took care of things while I was on vacation. Right there, trading covered calls and short puts. You can view the full playlist right there. And you can see very frequently we talk about covered calls along with short puts. All right. Anyway, but let's get to our existing positions. Let's go to the Thinkorswim trading desktop software platform. I botched that all up. Anyway, you know what I'm talking about. Here are our 5 positions: Apple, Abbott Labs, IBM, Tesla, and Wells Fargo. Let's start things off with Apple. Right now, we just own 100 shares of Apple, but this one's kind of been through the wheel cycle. We talked in a previous webcast series about in the previous webcast about the wheel strategy. And this is how Apple started its life in our portfolio. So back here, you can see this blue oval that indicates where we started this position. At that point, we sold the 21st of March 235 put. That was assigned. So at that point, our $3 premium that we had collected became a realized profit on that. We were assigned at $235. We then sold a 235 call against that position because we had dropped down below 235 at the time of assignment. Sold a 235 call, closed that out for an 80-cent profit. We retained those shares, sold a 16th of May 230 call, closed that for a $1.49 profit. But boy, the stock has actually not treated us terribly well. So this position is currently still underwater. We've collected a profit here of $3, a profit there of $1.49. It's $4.49 plus 80 cents. You know, just north of $5 a profit, but our stock position is significantly underwater, so we're still below our break-even point right now. And we just have that single stock position. Well, let's do this. Let's go ahead and sell a call against this position. We chose not to last time because we had an earnings announcement coming up. I was going to be on vacation. I didn't want to leave that over earnings without providing some oversight in webcast. But we're clear of that earnings. We're sort of in recovery mode. We'll see if that continues. But, you know, it looks like there was a recent ceiling right up here around 225. For some covered call traders, what they'll look to do when they're choosing which strike price to sell, they may look at a level where they think the stock doesn't appear to be likely to climb above by the expiration of that contract. And let's just say we're looking back at these highs. I don't know. I haven't gone to check these contracts yet. I wonder if we could get a quote-unquote decent premium for the June 20th 225. Momo says, can you tell me the criteria for selection when you consider dividend stocks to double dip? So Momo, I included a link for you that goes into some pretty good detail in how a covered call trader might choose a stock. I'm not going to be going too deeply into that to provide some more time to discuss 3 other motivations for selling covered calls. But yeah, you may want to check out that link for anyone else who's here in the live stream. You can just scroll up. If you're watching on the archives, what you can do is just go to that playlist that I showed you and look for planning and placing a covered call trade in 5 steps. That was the name of the webcast. You can just look that up. That's the one that I'm referring to. Anyway, but let's go see what we can get for a 225 June contract. So let's go here to the 20th of June on the trade tab. 225, all right, that's trading for about $2.50. That's just north of 1%. Some traders have a 1% minimum. That's not universal. Not everybody does that. But let's just say we're going to sell that 225 call. I'm going to click on the bid price. We just have 100 shares, so we want to make sure that we just have the one contract queued up to sell. Sell that 225 call. Looks like we might be able to get $2.40 for this. Let's hurry up and send this off. Click confirm and send. We're going to sell that 20th of June 225 call, trying to get 240. When we submit a limit order, there's a risk that order might not fill. This is going to tell us the max loss is infinite. That would be true if this were an uncovered call. This is a covered call because we're doing it against an existing stock position. There is a commission to be considered here, but let's send this order off. And let's see if we can get that thing filled. And while that's working, so it's right up here on our working orders under our monitor tab. Oh, look at that, sold for 241. Cool. All right, so I'll update that on our graphics here. I'll draw a line in here later to indicate that we've sold a call. Actually, why not? Let's just do that right now. Right click, let's edit the properties of this resistance line. Let's make that red to indicate that we sold a call there. And what's today? It's May 12th, so we'll have this start May 12th. And let's have it end June 20th. That's actually fine. That's right where I've drawn it, so that'll work. It says June 20th. We'll back that off to June 20th. Click OK. And so you can see there's our line. And then if we want to make a note to ourselves, we can just click, put a text note right there. Sold the, what is that going to be? That's the 19th of June. And that was the 225 call for, and I think we got 241. Was it 241? I think that's right. There we go. I'll change that to a red. And I think that's right. You'll notice here in our Apple, we're just still seeing the one quantity. It's because we just sold that call. It's down here in our unallocated area. So I can come down there and right click on it And let's move that to our covered calls and short puts group. There we go. Now it's combined. There's our 100 shares. We sold the one call, sold it for $241. That's perfect. It was the 20th of June. Let's correct that. 20th of June. This is what happens when you go on vacation. You get a little out of sync with the expirations and things like that. All right. Anyway, done with that trade. We have a couple of other positions. We have Abbott. Abbott Labs is a covered call where we bought the shares for $128.68. We sold the 135 call, and what we'd like here is for the stock to rise and get closer to 135, but to stay below that, so hopefully that call can expire worthless, and that's just what it's doing. So the stock is going up above our entry price. It's still below our 135 call, so that's still out of the money. Assignment risk is reduced when a trade is out of the money. It's still present, but let me just show you that one on a chart. Sometimes helps to visualize these things. Bought the stock here. There's our call up there. It expires in just a few days. We could still get a rally. We could still pop in the money. This could still get assigned. It's just less likely right now. So we'll let that continue to work. We also have IBM covered call. And this webcast series is covered calls and short puts. I want to assure you, yes, we do short puts from time to time. They've just expired while I was out. Anyway, but our covered call position here, bought 100 shares at $249. We'd like those shares to go up in price. They're doing that, but we'd like those shares to also stay below $260, and we're doing that as well. So we'll let that one continue to work. If you want to see that one on a chart, here's IBM. Bought the shares back here. We've actually collected some profit on some previous calls as well. Collected 203 here, realized a profit there, realized a profit here. This looks like it's in position to add to those profits, but still a possibility. If the stock were to collapse, we could fall underwater on this trade. If it were to rise sharply, we could get assigned. Assignment risk is still there, even while we're out of the money. It's just not as likely. But we're going to let that one work. With Tesla, here's Tesla. Let me show you what's been going on with Tesla. So, oh, I was wondering, there we go. Didn't get that last letter in there. There we go. Bought some shares at $233.07. Sold a call up here to expire right before that earnings announcement. That call expired worthless. So that's a realized profit of $249. And we chose not to enter a new call over that earnings announcement. Well, now we've broken up through resistance. The stock is starting to move again. Could it be encountering some more resistance up here? We'll see. NK says, so when we sell a covered call, what are possible outcomes? Is it that it either expires worthless or it's assigned? Only two outcomes. Well, if we just turn it on and let it go, yeah, either it gets assigned or it doesn't. That's an either or scenario. Or we may choose to do something with it along the way. We might choose to buy that call back. Now, we might be buying that call back at a higher price than what we originally received, in which case the call is not making money. We might buy that back at a lower price, in which case the call option might make money for us. But also we just have to look at what the share price did in the meantime as well. So a few potential outcomes, and I've actually dedicated previous webcasts to understanding what can happen at expiration. So you may want to go check those out in our archives. It's a good question. But with this one, we just own shares. So there's no consideration for what might happen at expiration. There's not an expiration in the equation right now, but let's do that. It looks like here there may be a previous support that might be a price ceiling right around 325. The next one might be up here at this previous high. That looks like that might be up around 365-ish with a little bit of rounding. I'm going to draw in a line there. Let's carry that out to expiration. And how about we sell a covered call? That's quite some distance, you'll notice, from where we are here. That might be so far out of the money, there may not be very much juice in that premium if we're considering a June contract there. But let's go see. Let's go to June. make sure that we're looking at Tesla. Let's look at, we don't even have enough strikes displayed. Let's crank this up to more strikes. Let's show 18 strikes so that we can see there's our 360. All right, well, that's still 1080. Is there, when I see a premium like that, I just want to check, make sure there's not an earnings announcement or something like that. I don't see anything, but just the volatility of this stock can really make the options, juicier is kind of I don't really like that term. That makes the options more expensive. So we might be able to get a higher percentage, even going up there at the we were going to go to 365. I'm not even looking at the right one. Let's look at just one more strike higher, 365. That's still close to $10. Still 3%. How about we sell that contract there? I'm going to sell that one 365 call, 970 to 975. Let's say we're willing to, I'm going to go under current price a little bit. I'm only doing this to try to get a quick fill while the webcast is running. I have limited time, but traders will sometimes reduce their credit that they're willing to accept if they're trying to get a faster fill or a higher probability for a fill. But let's click confirm and send. Going to sell that 20th of June 365 call, trying for at least $9.65. There is a commission to be paid if the order fills. And let's send that order off and see if we can get in that contract. Asking 965. The mark, look at that, it backed off a little bit. The mark is now 965. There's a risk this order might not fill, but it did. There we go. Sold at 970. All right, I'm not going to fill out the graphics on the chart. I'll do that before next week's webcast. But there's Tesla, and you can see Tesla's been doing very well for us overall. Up $8,500 on the trade net, actually, plus this profit on the previous call. So tack on another $2.50 profit per share there. And then finally, we have Wells Fargo. Wells, we have 100 shares in at $70. Those are now $75 stock. That has had a choppy ride. We sold some calls along the way, but we're now in a call. We talked about this. We were careful to discuss this. When you sell a call below the price at which, below the stock price that we paid for the stock, we're now agreeing to sell the shares for less than they're worth. And you might say that's kind of come back to bite us, but somewhat. Let's look at that one. Here's the sequence of events that led us to make this apparently irrational decision. Bought some shares at $70. As those shares rose, we were able to sell some contracts against those and collect some profits. Made $1.65 here. We made $1.22 here. But the stock was falling. Stock was really getting hammered. So along that way, we sold a 67.5 call for another $1.23. That brought our break-even point down to $65.90. So if we get called away at $65, did we lose or make money net? Yeah, in that case, we're still making money. And then the stock just blasted off. So in this case, yeah, we would have been better off had we not sold this particular call. But you don't win every time, or at least the trader doesn't make the maximum return every time. And in this case, our return is looking like a very likely just $90 profit. Take out some commissions along the way. We made some money, not a lot. That's been a choppy one. All right, but overall, those are our current trades. And our Tesla, let's move our Tesla new short call position. Let's right click on that and move that up to our covered calls and short puts group. There we go. All right, so now let's plan and place a new covered call trade. But before we do that, let's go get a gauge for what's going on with the markets. And it looks like I chose the right day to come back, right? I had no influence on this. But yeah, the S&P apparently reacting to some positive news along the tariff lines. We'll see how all of that ultimately settles out. But as of this moment, the S&P is going up nicely. advancing higher. Somebody says, this is a risk to covered call traders, right? If the trader's motivation is the income, but they don't want to sell their stock, this is not a strategy for someone who doesn't want to sell their shares, because inherent to the strategy is a contractual obligation that we might have to sell shares. And when we get a strong move up like this, it makes that more likely. Now, depending on how the trade is structured, if a stock, let's say the market pops and our stocks pop, and let's say we get called out of a position, does that mean we lost money? Or does that mean that it's a negative outcome? Well, it probably shouldn't be, unless we did something weird, like sell a contract that doesn't that's below our break-even point. Sometimes, of course, that happens. We can lose money on a stock that's been misbehaving, but getting called out generally produces a profit. Sometimes it's not the best profit that could have been accomplished, but a profit nonetheless. So it's not always a negative outcome. And as a matter of fact, it just usually isn't. Anyway, but the S&P starting to make higher highs and higher lows, pretty sharp correction from this bear market that we just touched into right down there. We've recovered most of that, and we're working up to being within a handful of percentage points of all-time highs again. So let's say that we have our covered call trader who still thinks stocks are looking up, they're looking better. They're planning a new trade. Let's go out here to June for this new trade. And as we do that, let's also take a peek at what's going on with the options market through the lens of the volatility index. This is a chart that some traders will look to get a general gauge for the premium scenario out there. Are premiums generally high right now, or are they generally low right now? How would you answer that question? Would you say that premiums across most stocks, are they higher than normal or lower than normal right now? Well, this chart gives us a feel for that. The trader can look at the current position and, the direction of this chart. But right now, this is where the volatility index is. Let's just carry this back through the last 12 months. And you can see a good portion of the time, the volatility index has been lower than it is right now. So actually, we're probably slightly above normal for the volatility index. So premiums, NK would say, premiums are higher but falling? Yeah. And if premiums continue to fall, then selling right now might not be a bad idea for the covered call trader trying to get the most out of the premiums. If they get higher premiums right now than are available, let's say in a few days or a few weeks, maybe they're doing themselves a favor. Now, obviously, that doesn't guarantee that the trade's going to turn out to be profitable, but maybe those premiums are as high as they're going to be for a little while. Time will tell. We'll see if the volatility index continues to drop. But yeah, if we think that we're always going to get the kinds of premiums that were available back in these days, that trader might be getting a little bit spoiled. That's not generally the normal circumstance for the volatility index. High volatilities those sorts of conditions tend to be short-lived. They can offer high premiums, but for a specific reason, it's because risk is high. And as that risk starts to settle out, premiums come down, and we adapt to a new normal. All right. So let's look at our stock trade for today. And obviously, people like to know why I select the stocks I do. What might motivate a trader to choose a specific stock for doing a covered call? I had that question in the chats just today. Well, there could be a number of reasons. This is not going to be an exhaustive list for every trader out there, but some fairly widespread considerations are, number one, liquidity. Illiquid stocks tend to have illiquid options, and there can be all kinds of pricing issues making it more difficult to trade those options profitably. The spread between the bid price and the ask price can grow really wide. Tough to get in, tough to get out. Yep. So liquidity can be one consideration. Price per share can be another consideration. In order to do a covered call, we have to buy the stock first. We have to buy 100 shares for traditional covered calls, or what we call standard contracts. Those represent contracts in 100 share increments. So a more expensive stock at 100 shares can get pretty pricey pretty quickly. So maybe our trader might look at this and say it's a $218 stock. To do one covered call, it's going to be about a $21,000, $22,000 venture here. A more expensive stock is going to be even more money. Price per share can be a consideration. Liquidity can be a consideration. But also, what's going on with the chart? I know that sometimes covered calls, because it includes a short call in the equation, it can sometimes be described as being a bearish strategy. It's not a bearish strategy. A covered call is at its heart a bullish strategy because of the ownership of shares of stock. If those shares collapse in value, that little covered call that we sold is small consequence for the big loss we're taking on the share ownership. So overall, it is a bullish strategy. And so they may some chartists may look to see, is the chart behaving bullishly? So here's General Electric, one of the biggest companies out there, about a $200 stock. And from a charting perspective, it seems to be breaking through a price ceiling recently. You can see over the last several months, it's really struggled at about that $212 level. Give or take a few pennies here or there. But the stock ran up to that level and was driven back a good amount down to about 185, 187. Rallied up to about that 212, 213, 214 level, and then got shoved all the way back to 160, and then rallied sharply, and finally we've broken through that level, and that may take some of the pressure off for some technical traders. They may see this as a big move, getting through that price ceiling, and it could send it higher. Obviously, we don't know for sure. But let's say our trader is bullish on our stock, so they're interested in share ownership, but they're also considering a covered call. Now, and LSSL says, is this session recorded? It is. Yep, this is the vast majority of our webcast series are recorded and then posted to our YouTube channel, Trader Talks Schwab Coaching Webcasts. Okay? But there can be a number of motivations for why a trader chooses to do a covered call. I want to talk through those, as I see it, 3 reasons for doing a covered call. So reason number 1 is the obvious. It's income. So if we buy these shares and they go up in price, that's appreciation. But also, as owners of shares, we can at the same time potentially get into a contract where another trader pays us for the exclusive contractual right to buy our shares at a fixed price. We get to sort of choose the price we're going to get into this deal with. But we're selling someone else the right to buy these shares that we're just buying now for a fixed price for a fixed period of time. And that can provide a potential income with the associated obligation. So that income is a primary motivation for a lot of traders. Maybe I could say most traders. I can never read everybody's mind, so I don't know for sure, but that's what comes up most often, I think. So let's go see what's available. So if we're buying the stock for around 220, I wonder what we could get if we agreed to maybe sell those shares for $230. Let's go to the trade tab. Let's look at that 230 strike for the 20th of June. That looks like that's trading between $2.90 and $3. Now, for an income-oriented investor who maybe they want the income, but they really prefer to not have to sell their shares of stock, they may be motivated to move a little bit further away from the price that they paid for the shares. So if we're buying the shares for $218 and agreeing to sell those for $230, well, it's comparatively unlikely that we're going to actually have to sell the shares. And if we do, we're selling them at a higher price than we paid. Okay? What is, somebody look at the numbers there on your screen and give me an approximation of the likelihood that this contract winds up in the money. If we just turn it on and let it go to expiration, what's the likelihood we're in the money at expiration and the contract gets assigned? There's a number here on your screen that'll give you an approximation of that, and that is our delta. Delta can tell us the degree of leverage on a contract, how much it might make or lose on a $1 move in the stock, but it's also an approximate likelihood in percentage terms of the contract being in the money at expiration. So there's about a 29% chance the stock will be above 230 at expiration. There's also some chance that the contract can get assigned before that. But yeah, so our trader might look at this and say, well, all right, so it looks like I can collect about $300 against this $22,000 investment. So it's a little bit north of close to 1.5%. And if I do have to sell, I'm selling for $230. So that's reason number one is income. Now, reason number two is related to income, but it gets overstated, I think, sometimes. So here's reason number two. Reason number two is risk management. What I would say, I think a little bit more accurately, is risk reduction. It's not a risk elimination. A covered call does not eliminate risk. However, let me ask you this question. We have Trader A and Trader B. Trader A buys 100 shares of General Electric. Trader B buys 100 shares of General Electric and sells a call against that position. Which of our two traders has a lower risk exposure in their portfolio? Which of our two traders? It's actually Trader B. Their portfolio risk has actually been reduced by the amount of the premium. So let's talk about that. And by the way, quite commonly, our income investors are motivated, not always. So don't take this as an absolute, even though I'm going to write it down on my scratch pad. Quite commonly, they will go out of the money for the contracts they're going to sell, because what they'd really like to do much of the time, they own the shares, they're going to sell a call that they don't think is actually ultimately going to get assigned, because once it expires, or if they're able to, before expiration, exit it inexpensively, well, then they're done with that one. They still own the shares. They can sell another call and hopefully collect more income, and then just keep repeating that process. But going out of the money just reduces that risk of assignment. Now, the risk reduction is accomplished, and this is where I think it gets overstated. Sometimes people will say that covered calls are a hedge. They're not a hedge. They're not a good hedge at all. If we want to hedge a stock position using options, what's a more effective strategy as a hedge? It costs more, I'll tell you that. Probably a protective put, buying a put. Yep, there's certainly costs associated with that. You say, well, yeah, but a call, I get to collect a premium. Yep, but it only reduces the risk a bit. It reduces the risk by the amount of the premium. So if our trader is looking to reduce risk, maybe they see some event on the horizon. They think the stock's about to get a little bit jumpy, and they want to reduce any risk of the stock, not reduce any risk, reduce net risk if the stock happens to fall a bit. Well, if they're looking to reduce risk through the mechanism of selling an option, and yet they sell a very inexpensive option. Look at this one. Might only get 8 cents out of this one, or a quarter out of that one, maybe $1 out of this one. Well, if we collect $1 from our premium, from our call, and then the stock drops $10 in value, well, we did reduce our risk. We might be able to close out our $1 call or just let it expire worthless. We have a $1 realized gain on the call against a $10 unrealized loss on the stock. It reduced risk just not very much. So what some traders might do, if risk reduction is a primary motivation, they may look for the somewhat more expensive options. So in this case, they may actually even look at, let's say, an at-the-money contract. What would this do for us? John says, I'd like to see any discussion of if and when rolling an option like a covered call. John, I've covered that in previous webcasts, so we're not doing that today. But once again, if you have an interest in specific variations on the theme of doing these sorts of strategies, go check out my webcast series archives on the Trader Talks channel. But yeah, for some traders, they might look at this trader who's going for income. You know, maybe this trader was looking at the 230 contract, Well, let's say maybe they got $3 from that premium. And then the stock, let's say the stock takes a dive and it drops 10 bucks. So now our $218 stock is only worth 208. At expiration, pretty unlikely that this contract would be assigned. It'd be pretty far out of the money. So they'd make a $3 realized gain in that scenario on their call, but they lost 10 bucks on the stock. So reduced the risk, but by 30% in that hypothetical scenario. How can they dial up the risk reduction? In that case, they might sell, let's say, an at-the-money call. This one looks like it's trading closer to $7. Now, let's run through that same scenario. Our second trader here is worried the stock's going to get a little bit choppy, and it does. It takes a dive. Let's say it goes down 10 bucks, so it goes from 218 to 208. We hit the 20th of June expiration. Well, the stock's worth 208. Someone has the right to buy it from us for 220. Are they going to do it? It's unlikely. They could. It's just unlikely. If they did, awesome. They'd actually be bailing us out. But no, in that case, they might just walk. They leave us with the $7 premium that was paid. And we just reduced that risk. That $10 loss on our stock was majority covered by this covered call. So that's a secondary motivation, is risk reduction. Sometimes traders do a combination of motivations, or have a combination of motivations. Here's our third reason. Reason number 3 is to exit the stock. And I'm just going to give it away. Yeah, some traders will actually go in the money in this scenario. If our trader is motivated by looking to exit the stock, why in the world, if you want to exit the stock, why not just sell it? Well, here might be the trader's logic. So the stock right now is trading for 218, and we could just, go put it in order and sell the stock for 218 and maybe some change, 218.55. We don't know if and until the order fills. But here the trader might think, wait a minute, what if I sold an in-the-money contract here? Instead of selling the stock right now for 218, I could agree to sell it to someone else for 210, but for that right, it looks like they're willing to pay over $13. Let's just call it 13 bucks. So if we're getting paid $13 right now, and if ultimately those shares are assigned and they pay us another $210, how much does a trader exit for? Well, my math says 210 plus 13 is $223 would be the equivalent sale price. So instead of selling our stock on day 1 for 218, maybe they sell it on day 39 for a net of $223 and maybe $223 and change. But yeah, selling an in-the-money contract is actually a high probability scenario for exiting the stock. And in this case, we can look at our delta, and there's about a 71% chance that that's just what will happen. This contract's in the money. The stock is still above 210 at expiration. The contract gets assigned. Yeah. Mark says, yeah, it's like selling at 223. Yeah, I'd never eat here says the same thing. So, yeah. Here we are talking about one strategy, but 3 very different motivations for entering into this. Let's take the position of this trader just going for income. So what I'm going to do here is go out of the money. We're going to try to retain ownership of these shares, so hopefully we can continue to generate income going forward. But you'll notice for each one of these, there are pros to doing that approach. There are cons to doing that approach. Taking the income out of the money approach, it gives a higher probability of retention of share ownership, but it also provides a smaller reduction in risk because we're only collecting $3-ish. But let's sell this contract. I'm going to click on the bid price. Let's hide this left column for a moment. 291 to 298. I'm going to say we're willing to sell for 290. Just because I'm setting that as my floor doesn't mean that that's what we'll sell for. If we can get a better price, it's still possible we sell at a higher level there. But let's try to get at least 290 for this. Let's click confirm and send. We're going to sell this one. Oh, we don't actually own the shares. Aha, I caught myself. Let's right click here, buy a covered stock. There we go. And we're going to make sure that we have the right, we have the right expiration, the right strike price. Looks like our net debit might be between buying the stock for around 218.5, selling a call for around $3. That brings our net debit to around 215.5. Let's say we're willing to spend up to 215.60. Let's click confirm and send. See if we can get a fill here. Buying the one covered GE 20th of June 230 call for a limit of 215.60. It gives us a maximum profit. If we buy at 218.5 and then we have to sell at 230, we can only make so much on the stock, plus the premium collected around $3 on the call. That gives us this maximum profit. Maximum loss if the stock drops to zero and we are the unfortunate owners of shares of General Electric when that great big original Dow component company finally goes to zero, we could lose that much. Anyway, there is a commission to be paid. And let's send this order off and see if we can get a fill. Let that work. Yep, filled 215.56. So notice I offered as much as 215.60, but a better price was available, and so we received a better price. There we go. Guys, let's move this. Move this to our covered calls and our short puts. There we go. But we've accomplished what I set out to do today. I want to talk through what's going on with our current positions, what's happening with the stock market, and what are three very different motivations for doing covered calls. Now, as I talked through that, I don't want any of those to say those should be your motivations. This is always just for educational purposes only. Just here to teach how these strategies work, and then it's up to the individual trader to decide if it's ever going to play a role in their portfolio. But guys, time for me to let you go. But as I do, just remember, if you haven't subscribed to that Trader Talks channel yet, here's where you would do it. You can go down, click on the subscribe button right below the video stream right now. But also just remember, you can go to YouTube, find our homepage, Trader Talks Schwab Coaching Webcasts, and you can find our playlists of all the archives of our published videos here. You can also join the live streams here. Also, make sure that you're following Barb and me on X. That's the best place to connect with your favorite presenters in between these live streams. So you can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. Now, finally, I want to thank everybody who has already clicked the thumbs up. I can see 181 people watching. 47 people have already clicked that like button. That's very much appreciated. That helps your presenter. It's a nice little pat on the back. It also helps my webcast with the YouTube algorithm. It just helps more people find the webcast and learn about things like the different motivations for trading covered calls. Hey, Marcus, thank you. Glad you appreciated it. Glad you found that useful. Everybody, I will look for you in a future webcast. I'll also look for you on X. Barb, thanks for helping out in the chats. But everybody, until I see you again, I want to wish you the very best of luck. Happy trading. Bye-bye.